Okay, the homework problem that you have is the equivalent of 19-1A. Here it's this Dowell company. You of course have different numbers, but this is what's in the text, and here's the solution for it, which is also loaded to Canvas. So let's go through and just make sure we know where these numbers are coming from. The problem itself wants to know first. It says this company produces a single product. That keeps it easy for sure. Income statements under absorption costing is for the first 2 years. There we go. It says the sales and production data for the first 2 years are as follows. Looks like in 16 they produced 10,000 more than they sold, and then in 17 they sold 10,000 more than they produced. Then they give us some variable information here, selling and administrative expenses. So they want us to prepare income statements for the company for the first 2 years under variable costing. So this is absorption costing, which has the format sales minus cost of goods sold, gives you gross margin, minus selling and administrative expenses. Now variable costing has that little bit of a different format. It's the contribution margin format. So starting with this, let's start with 2016. This is where they sold, they produced 30,000 units and sold 20,000. So that's why sales for 2016, sales at $46 a piece, which is what they said. No difference in sales, 920,000. Let's just do 16 first, and we'll come back to 17. The variable expenses under variable costing would be what? The variable product costs are only the direct materials, the labor, and the overhead. That's 5, 9, and 7. So that is $21 a piece. So that is, how many units did they sell in 2016? 20,000. So 20,000 at $21 a piece is 420,000. The variable selling and administrative expenses, which are $250 a piece, that's what they said here, times the 20,000 units is 50,000. So the total variable costs, and then the sales minus those variable costs is your contribution margin, minus your fixed factory overhead, which is how much? 300,000, and fixed selling and administrative, 240,000. Gives you net income negative $90,000. Now we'll do the same thing for 2017. They sold 40,000 at $46 a piece. So total sales, which is no different than what they had before. The product costs at $21 a piece for the 40,000 units they sold, 840,000. The variable selling and administrative costs at $250 a piece for the 40,000 they sold, 100,000. Gives you total variable costs, those two added up. Subtract that from sales, gives you contribution margin. Then subtract off your fixed overhead expenses. Fixed overhead and fixed selling and administrative to get to net income. Notice there is a difference here. Under absorption costing, we showed 10,000 of net income for the first year. We're showing 90,000 loss for 2016. So it's just a matter of how we treated the fixed factory overhead. We expensed it in full under variable costing, and we presented it in a different format. Second, they want to explain the difference between the two. Well, it's how we treated fixed factory overhead. In this first example, the fixed factory overhead, let's see here. Yeah, now notice that the only thing that we're treating differently under these two methods is this fixed factory overhead right here. And that is under absorption costing, we're including $10 per unit in the product. Well, since this very first year in 2016, since we produced 30,000 but only sold 20,000, there's still 10,000 units in inventory. And how much fixed factory overhead is in those 10,000 units? 10,000 units at $10 a piece, that's $100,000. So that's why going variable costing is different from absorption costing by that $100,000. And variable costing is less because we expense all the factory overhead under that. Then, of course, in the second year, we are not only expensing all the fixed overhead of the second year, but that $100,000 from the first year, because we are selling now $10,000 more than we produced. We're expensing everything this year plus some of the prior year. So that's where that came from. Yeah, so this is just an exercise of pulling the numbers together. Follow, if you have to, put these two side by side and see where they're getting their numbers. And they tell you here. We're just treating fixed factory overhead differently. The second homework problem that you have is right here. It is the Trez company. So let's go ahead and do that. 9-2A is what that is. Okay. It says this company began operations this year. During the first year, the company produced 100,000 units and sold 80,000. Oh, so they produced more than they sold. That means that some of the fixed factory overhead is not going to get expensed. It's going to some of it's going to get caught in ending inventory and not make its way to cost of goods sold this year. But it does say for the 80,000 units that we did sell, we sold them for $50 a piece, $4 million. No beginning inventory. We manufactured 100,000 units at $30 a piece. And that $30 a piece came from right down here. Direct materials of $5 a piece, direct labor $14, variable overhead of $2, and fixed factory overhead $900,000 of fixed factory overhead divided by 100,000 units produced is $9 per unit. That's $30 a piece. We sold cost of goods manufactured. So the 100,000 that we made cost $30 a piece. But 20,000 of those are still in ending inventory, so we only showing the cost of goods sold. The 80,000 we sold at $30 a piece, $2.4 million. Minus selling and administrative expenses. So that was their income statement under absorption costing. Additional information, selling and administrative expenses include $350 in fixed cost, $225 per unit of sold for variable. Now they want us to prepare an income statement for the company under variable costing. Okay, remember now, variable costing, change the format a little bit. Sales minus variable costs to get contribution margin minus fixed costs. Okay, well, sales will be the same. It's 80,000 units at $50 a piece is $4 million, same thing. But the variable costs will be the variable product costs are just these first three, the 5, the 14, and the 2, which is $21. So the variable cost of those 80,000 units that I sold was $1,680,000, and the variable selling and administrative costs of those 80,000 units I sold at $225 a unit. That's what they said right here, $225 a unit. Total variable costs, subtract that from sales, you get contribution margin. Then subtract off your total fixed costs. $900,000 for the factory and $350,000 for selling and administrative. Under variable costing, our net income is only $890,000. Why the difference? Again, they want us to explain the difference just so we get the concept down. Well, it's because now let's go back to this absorption costing and under variable costing. The only thing that was treated differently was this fixed factory overhead. Under variable costing, we are expensing all of it. Under absorption costing, we only expensed 80% of it because we made 100,000 units and we only sold 80,000. So we only expensed 80,000 of it. So 20,000 units, or 20% of the units that I produced have attached to it 20% of the fixed factory overhead. And the fixed factory overhead was, oh, now I lost it. Where's the fixed factory overhead? Oh, 900,000. There it is, 900,000. So 20% of that, or 180,000, is still in inventory, in those 20,000 units that are still in inventory. That's the difference between these two, $180,000. the 20,000 units at $9 a piece that are still in inventory. And they explain it here. So a strange chapter, certainly. I believe it has its merits. It was probably the result of someone's doctoral thesis of some kind. They came across this and said there's an opportunity for managers to manipulate net income, not by manipulating sales levels, but by manipulating production levels, because they can manipulate the fixed factory overhead. They can keep more of it in inventory. Think about it in terms of this. Suppose I was going to make 5,000 units and sell 5,000 units. Well, all the fixed overhead would attach to those 5,000 units. They'd all be sold. It'd all be in cost of goods sold. But if I made 10,000 units and only sold 5,000 units, well, only half of that fixed factory overhead would be attached to the 5,000 units sold. The other half would be in ending inventory. And it will catch up to this person. It's because next year when you sell those units that you attached fixed factory overhead to, it's coming into next year. So it's almost like a wave. You got to keep it going. But that's how we treat it. So that's the difference between these two methods. So really, I just want you to understand, recognize that there are two different methods. What cost is treated differently under the two methods, and how is it treated differently under the two methods? Variable costing completely expenses fixed factory overhead right off the top. Doesn't even get a chance to get attached to inventory. Absorption costing, however, attaches fixed factory overhead to products, and if we don't sell all the product we produce, then it doesn't get all expensed. Absorption costing provides an opportunity for managers to manipulate data. We don't want that, so we are going to probably use variable costing for purposes of evaluating managers' performance. So, okay, with that, continue working on the homework. We have an exam coming up according to the schedule next week, I believe, depending on when you're watching this. So I will load a review video to give you an idea of what to study for and what to look for toward the end of the week. It might already be there by the time you watch this video. So hope you're doing well, and just stay with me.